Hi everyone, good afternoon. So as Ritanshu explained, we are strong promoters of when it comes to Bitcoin or digital assets in general, because when we move to the next slide, I'll be showing you all the cumulative as well as annualized returns for each of the different asset classes. Yeah, so we ran through the annual returns of the different asset classes over the last 10 years, and we also got the cumulative as well as annualized returns for the same. So here, as you can see, we have all for Bitcoin, for commodities, real estate, S&P, gold, as well as bonds. As you can see, the cumulative returns for Bitcoin is greater than all of the cumulative returns for all the other asset classes. However, Bitcoin also shows strong volatility, as experienced by 5516% in 2013 to 1300% in 2017, and 156 and 302% into 2023 and 2020 respectively. So when you, on the other hand, when you look at, for example, say S&P or real estate, they have shown steady growth, and they are so basically they have moderate returns, and at the same time they are steady. So it's a steady source of income for anyone who invests. Bitcoin has more volatility, but at the same time it is more of a high risk, high reward system. On the other hand, when you say, for example, when you talk about say gold or bonds, they are low returns, but they are steady and solid forms of investment. Now let's talk about digital assets versus traditional assets. So what is the correlation matrix? The correlation matrix is something where how digital assets such as Bitcoin, Ethereum, or any other cryptocurrency for that matter, how do they interact with your traditional assets, such as your stocks, bonds, commodities, gold, so on and so forth. As you can see, say for example, if Bitcoin goes up by 1%, Ethereum goes up by 0.88, which indicates that there's a direct correlation between the two. On the other hand, when say for example, Bitcoin goes up by 1%, the bonds fall by 0.15%. What this correlates is basically that these are inversely related. So, for example, the whole purpose of this correlation matrix is to ensure that when you build a portfolio of your own, a negative correlation means that it is better for you to diversify your investment, because it will give you the same returns with maybe lower volatility. Because say for example, if Bitcoin goes up a certain percent, the gold will balance it out. So your returns are not affected, but the volatility is less. So basically, this is for long-term, more sustained investment to diversify your risk. I have a question for all of you. Why do people fear crypto? Anyone? Yes. Okay. Anyone else? Sorry, I can't hear you. IP address privacy issues. Anyone else? You mean like a regulatory body? Okay. Anyone else? There's one thing I would like to add to that is that here you're just talking about Bitcoin, just to be clear. But Bitcoin is not digital assets as a whole. Bitcoin is a part of it is a part of an asset class, which is digital assets and crypto. Yes, as you said, there have been projects which, say for example, they have not lived up to their potential, or maybe it's been a rug pull. There's a lot of meme coins that have been going on around, which has been the problem. But I feel that when you talk about digital assets, it's very important to understand two things. One is that it is a relatively new field, so people are still trying to understand how it works. And secondly, it is that the main problem I feel, which strongly feel that digital assets are facing at the moment, is that of volatility. So how do we deal with the volatility that comes with the digital assets? And we ran through some numbers, and here are the results to show you. So when you talk about all the different asset classes, all of them have volatility to a certain extent. All of them will fluctuate from time to time. But those such as Bitcoin will fluctuate more than the others. Why? Because even though it is backed by reserves, at the same time it is also affected by external factors. So just say, for example, as all of you here must be aware about Trump being sworn in the US. So in the days leading up to the election, in the days leading after he won, and before his swearing-in ceremony, all of these things. How many of you here have been tracking Bitcoin at least in the last year? How many of you have been tracking Bitcoin in the last year? Right. So you must be very aware that what are the factors that come into play. Now, say for example, if you talk about the current trends also. So when you talk about that, Eric Trump has recently said that he wants to abolish income tax for all crypto-related businesses and firms which are starting up or which are already established in the US. Why are they doing that? They are doing that because they believe in the potential of the currency. And now, say for example, if you look at it here, although Bitcoin has a 72.9% volatility rate, still it is the one with the most significant returns, all because people believe in the potential. You don't buy the idea. You buy the concept. You buy what it is backed by. Now, say for example, people blame meme coins that they have basically led to more rug pulls, or maybe people have made losses. But that is because people think of crypto as a way of making quick money. It's not the case. It is like any other asset class. If you invest in gold or commodities, would you just invest just because it gives good returns? No. You understand the idea behind it, and that's when you invest. Same way, there are a lot of good cryptos which will give you good returns, be it Bitcoin, Ethereum, Avalanche, any of these. It can be any of them. It's all about you understanding and then investing. No form of investment should be done based on the hype train. Always do your own research is what I strongly promote before we do any form of investment. Now, as I said, when you are building a portfolio of your own, there is something known as the modern portfolio theory, right? So what this is I'll explain it to you in the next slide. So basically, what modern portfolio theory is that investors can maximize their gains for a given level of risk by diversifying their assets between different asset classes. There will be two examples that I'll be showing you. The first one is a traditional portfolio that is built with only the traditional assets without digital assets, and the other one is the one with digital assets in place. For example, there are three forms of portfolios that have been built over here. As you can see, the first one is the conservative portfolio, where only 5% of it is digital assets. All the rest of it is in S&P 500 bonds, golds, REITs. So as you can see, even though the expected return is lower and the volatility is less, it all depends on your appetite as an investor. It all depends on what your level of risk-taking appetite is. Now, say for example, one of you may want to adopt a more conservative approach, where over the years they want to get a steady state of return while taking minimal risk. That is all for seasoned investors. They are the ones who want to do this. On the other hand, if you have a very large risk-taking appetite, now say for example you are young, you are just starting out, and you want to ensure that you want to try new things basically, because when you are young, you generally have that fire inside you where you want to try something new. Maybe you'll burn your hands maybe once, but it will leave you with the experience of a lifetime. So in that case is when an aggressive portfolio type comes into play, where around 40% of your portfolio consists of digital assets, right? So in that case, you have a 15% of an expected return. even though there's more volatility, you will be more open to doing that. Why? Because you feel that high risk, high reward, and it is something which I have seen in a lot of people between the ages of 25 to 35 who are more willing to do that, because they understand the true potential of this market, and they will be like, okay, if I lose, I lose, but if I win, what then? That is what the mindset is. So that's where people are starting to pivot towards these days, given the popularity of Bitcoin especially. Now, here you can see two things. The first one is a portfolio excluding digital assets, and the second one is a portfolio including digital assets. In both the cases, the returns are the same. But as we mentioned in the correlation matrix earlier, what happens is that, because as I said, that Bitcoin and Ethereum have a positive correlation, which means that both of them will go up simultaneously. And on the other hand, bonds has the exact opposite. So in this case, there's no digital assets, so there's more volatility because all of them are pulling in the same direction. On the other hand, here there's a 5% of digital assets that are there in play. So the volatility is balanced out by Bitcoin and other asset classes. Hence, there's low volatility with 6.25% of annualized volatility in the portfolio, including digital assets. As you can see, this is what is called as an efficient frontier curve. So basically, what this does is that it shows the best risk-return combinations, and adding Bitcoin shifts this frontier curve upward, which means that there's a higher risk-reward ratio for the same. In the bottom, as you can see, over here is the one without the digital assets, right? And on the top is the one with the digital assets. So as you can see in the graph, although there's a higher volatility, there's also a higher return. So it is for those people who believe that diversifying their risk is the way to go, and because they want to have a higher reward as well in the future. Now, I want to ask you all a question. How many of you here know what a Monte Carlo simulation is? Okay. Anyone else? Okay. So basically, what Monte Carlo simulations are that it is a prediction model which is basically used to calculate different portfolio returns by running thousands of different market scenarios. So basically, what it does is that it assesses potential risks in the market, and it also predicts long-term portfolio growth by running tests for different asset classes through different market scenarios. It also does stress testing for the portfolio management in different market conditions. In this scenario, what we have done is that we have simulated 10,000 different parts of a portfolio consisting of 50% S&P 500, 20% bonds, 15% Bitcoin, and 15% Ethereum. Now, the factor that we have considered for this is that we have assumed that the S&P 500 has an average return of 8% with a volatility of 15%. On the other hand, there's bonds where the average return is 4% and the volatility is 5%. The Bitcoin, which has an average return of 50% and volatility of 80%. Ethereum, on the other hand, has an average return of 60% and a volatility of 90% with a simulation period of 10 years. So here, as you can see, when you talk about the traditional portfolio with a low correlation, the average annual return is 7.2% as compared to the annual return of 12.5% for a portfolio with digital assets. On the other hand, the volatility is still lower in the traditional assets as compared to the crypto one, which is 18%. So in this case, we'll be considering two scenarios. The first one will be where, in case of a loss. So if there's a loss, there's a 5% loss in the traditional assets without the digital assets. But when there's a 15% in the crypto one. But that is the downside. But the upside is massive, as you can see. That the best case scenario, there's a 20% gain with the traditional assets. But when you talk about with the crypto, it has a 50% upside to it. So now I just want to ask a few of you, if you were an investor, which one of the two scenarios would you choose? Anyone? Exactly. So when you talk about digital assets, as you said, how old are you? 22. So as I said, that all the young people, they will prefer the higher upside. Why? Because they have the risk-taking appetite in them. So it's all about your mentality as an investor as to how you, where and how you want to invest and what is your risk-taking appetite. As you say, this is a Monte Carlo simulation growth over the portfolio growth over the last 10 years. The blue lines, they symbolize the traditional portfolio, and the other one signifies the crypto portfolio. So as you can see, these blue lines are pretty steady. So over the years, they will give you steady returns, stable returns. But on the other hand, when you say, for example, if you go into the crypto one, so they will give you, maybe in the initial years, they will be a bit steady as well, but then they will give you a much higher return because over the years, as and when regulations become clearer, and when you get to know as one of you in the crowd mentioned, that there's no clear governing body. There is no clear governing body, there's no clear framework. Yes, but that is the case in maybe India and a few other countries. But when we talk about other countries such as the US, there's Singapore, there's Russia, there's China, all these countries, they already have an established framework, even Thailand for that matter, as a matter of fact. So you will have countries which are coming up with their play, and there is something which we'll be discussing in the next few slides, where it is a global reporting framework which will enable all the countries in the world and all the jurisdictions to work in sync to basically tax crypto and at the same time have a regulatory framework in place so that if anything goes wrong or if there's any clarity that is required, they can always revert to that governing body to assess their doubts. What are the benefits of basically any benefits of integrating digital assets in your portfolio? So the first one is that enhanced portfolio efficiency. As I said, the correlation matrix showed us that when we talk about including digital assets, the more diversified it is, the better the chance of getting a returns with a lower risk, because risk is mitigated by different asset classes and their potential for growth as well as downturn. The second one is an improved return to risk balance, where, say for example, even if you are taking a risk by including digital assets in your portfolio, you still because see, even if you are taking a risk with Bitcoin, on the other hand, you have steady state investments also, and which give you moderate returns in your portfolio, such as you have your bonds, you have your commodities, you have your S&P 500. So you will also be diversifying your portfolio based on what you want out of your portfolio. So that is the improved return to risk balance. The third one is a tailored portfolio design, where when you talk about the correlation matrix, your financial advisor, see, everyone who invests, most probably has a financial advisor. They have people who advise them on the same. So they will be running these tests for you to make sure that the portfolio is tailored to your risk appetite and how much money have you invested and how much maybe, say for example, you are prepared to lose in order to win big. Because there are two types of mentality that people have when it comes to investing. One is the gambling mentality, where it's always high risk, high reward. And the second one is the seasoned investor and the veteran mentality, where it is always low risk and moderate returns. The fourth one is with digital assets, and the fifth is without digital assets. It all depends, as I said, on your perspective on investing and how much you are willing to learn from it. Now, crypto taxation. So as I was saying, there is something called the Crypto Asset Reporting Framework, which is basically spearheaded by the Organization for Economic Cooperation and Development. So basically what it is designed to do is it is designed to automatically exchange taxation-related data, on crypto transactions across different jurisdictions. Say for example, between the Dubai and the US, for example. So between the Dubai's VARA and the US jurisdictions, there's a way of exchanging taxation data. So basically it mandates crypto platforms such as brokers, exchanges, custodians to exchange different forms of data between each other, such as for crypto to crypto exchanges, crypto to fiat exchanges, and retail payments which exceed $50,000. All of these jurisdictions already are adapting this framework, and they already want to have it in place by 2027 in order to give a clearer idea on crypto transactions. Because as we said, that in this space, the regulation is very important. It's a relatively new field, and when it's a new field, there need to be clear guidelines and structures in place. Especially, for example, in a country like India, where the population is so massive, the spending potential is so massive. So it is very important to regulate it, because right now there's a lot of issues in the market, as all of you must be aware. So we need to, and the best way to eliminate this is to have guidelines in place, because in most of these cases it is generally not an intentional mistake, but because the guidelines are not clear, people think they can play around it, and it is not the right approach, to be very honest. Even though there's no regulation, it is important to be self-regulated, and that is what we at CIFDAQ believe in. Taxable events and reporting requirements. In this case, what is taxable? It is basically selling or exchanging cryptocurrencies, using cryptocurrency to purchase goods and services, and earning income via mining, staking, or yield farming. And what are the reporting obligations? You need to give your customer identity, the type of the transaction, the size of the transaction, the date and time, and where was the crypto transferred, like your wallet address, your blockchain, everything they have to report, and also the cost basis as to how much was taxed, or how much of the fees was taken by the exchange or the broker partner in question. Now there is something known as the Common Reporting Standard, which complements the CARF and applies to financial accounting holding e-money or tokenized assets. Businesses can choose to report under either of these two, depending on the business and the scale at which they operate in. Crypto taxation in India. How many of you are following the budget, and in the last 2 years, what have the crypto taxations been? 30% plus the 18% GST and the 1% TDS. So essentially it makes it 49% of tax, right? So as I said, that when it came out in 2022, a lot of people in crypto were very skeptical about the tax. Why? Because almost 49% was had to be paid to the government, and hardly around 50% came to them. And that too, it was mainly because, and that too, it was only on profits. The losses were already written off, so they are losing more money than they are making essentially. So there's a need for a stronger taxation system, because in this case, when you talk about taxation, people need to have a fair idea of why they are being taxed so high, and what is the logic behind it. This is a very common question amongst crypto investors today, as to where are all the profits going. The answer is in the next slide. That is where it's going, right? So when you talk about crypto taxation in India, it includes cryptocurrencies, NFTs, and other digital assets. They are not a legal tender in India as of now, but they are taxed as digital assets. And the current tax framework highlights that the flat tax rate of 30% on gains from VDAs. There's no deductions, only the cost of acquisition is deductible, and no other expenses can be claimed. And the one which is bothering the crypto community the most as of now, as every one of you must know, whoever invests, is that they cannot be offset against gains from other assets or carried forward, which is a huge issue for maybe, say, for example, retail traders can still find a way to get past it. But when you are operating on a very institutional scale, or when you are hedging, so you will face troubles with the tax, because even within your accounting, because it is very difficult to maintain a track of all of this after a point of time. The main challenges facing our regulation right now is a 30% flat tax and 1% of a TDS burden retail, and reduced market liquidity and risk of capital flight. Because there will be lower liquidity in the market. Why? Because a lot of the money, or around almost 50% of it, is going into taxation. So there will be even market makers, liquidity providers, exchanges, and even us as an exchange. We know what goes on in the back end. So we also understand the trouble that liquidity providers, market makers, all of them are facing when it comes to taxation, because a lot of their liquidity is going towards paying taxes. There's also a regulatory uncertainty, where all of you might be aware that 2 years ago, crypto was a gray area in the country. It still is kind of, because there's still 50% tax, but there's no background, there's no reporting body. Like, say, for example, the stock market has SEBI, but the crypto market right now just has a tax. It doesn't have a regulatory body, as the gentleman over there just mentioned, that there's no regulatory body to fall back upon. There's also cross-border complexities, where the transactions on global exchange create compliance-related issues, because as of now, you cannot form an account on an Indian KYC on a global exchange and then remit your money out of India, because that's where the regulatory bodies such as ED and FEMA come into play. Now, what are the current developments in this crypto space as of now? India launched a pilot for the digital rupee, so which is known as the Indian CBDC, or the digital rupee, which may have a distinct tax regime. There's also the factor of the international cooperation, where India's adoption of global frameworks like the OECD CARF may enhance tax reporting obligations. And in the future, there has to be a focus on balancing regulatory oversight and market development to foster growth amongst countries and to grow the crypto economy as a whole. What is the current sentiment around crypto? There have been a lot of developments globally, as I mentioned, that in countries like US, Singapore, Thailand, all these places, they are very bullish when it comes to crypto, because they understand the true potential of it, and they have understood what exactly is the framework behind it. There's also liquidity improvements and market infrastructure development. And as I said, that crypto has nothing to do with your traditional asset classes, and maybe that is its biggest strength. Because when it comes to building a portfolio, or when it comes to maybe say, for example, diversifying your assets, you don't face a problem because both of them have very different frameworks. So it will help you diversify your portfolio, while at the same time ensuring that you don't face the volatility issues which would have come if you would have just invested in digital assets. Bitcoin also reached the 100,000 milestone recently, which is also a big step and signifies significant global adoption in the crypto market. How can you start your trading journey? This is something where Ritanshu will be taking it forward. Thank you.
So thank you so much, Rahul. You gave me more time for for the audience with me. So guys, give me the. I always forget. Guys, before delving into that, I've been into portfolio management services, and like the first thing which I prepare when I'm meeting a client, what do you think it is? Can someone, like any one of you, what is the first thing a portfolio manager does? Anyone? Do you know the term? What should we call it? Come on, guys, it's an MBA college. Nope. It's the first statement that we make. You're close. Oh, come on. Yes. Who was this? Who said this? Investment. Yes. Exactly. Did you Google it? You have your tab right there. I thought you just Google it. Okay, so he's right. It's IPS, Investment Policy Statement. So basically what do we ask from the gentleman is that what is your core risk appetite? And we just want them to get the bestest of returns, because we as portfolio managers, we have our fees dependent upon their returns. We have high watermark fees, we have management fees, and we have various other kind of fees. But we make sure that our clients is happy. So in that IPS, all the students or all the individuals, I'm meeting HNIs who are 25 years old, 22 years old, some are 18 years old. And they are not HNIs because they are 18 years old, because their parents are HNIs. So this is the reason. But they come up with things like this. So when they come up to us, they always want that, Ritanshu, we do not need returns in percentage, because they are coming in crypto. So they come up with, we need returns in Axis. अगर Bitcoin को देखें, मेरा एक client था, Feb में, उसका portfolio was somewhere close to 8 to 20 CR. Now that portfolio is currently standing at 30 CR. Why? Because at 8 CR he invested in Bitcoin. At what rate? $30,000 to $35,000. And currently Bitcoin is standing at $105,000. So you can imagine the kind of returns he had generated. Why I am telling all of this is, you just notice in the PPT that even 5% inclusion of your portfolio in digital assets can fetch you this kind of significant returns. And imagine you all are young. And even I want that 80% of your portfolio, like if you diversify it well, you can fetch like returns in excess. Trust me on that. And how you can start all of this is from our exchange. We are planning to launch our CIFDAQ exchange. We have already launched it on the global pace, and it launched on November 12th. But now we are planning to launch in India in February. Sorry, I just skipped it. Yeah. So CIFDAQ is a cutting-edge hybrid exchange, and it has like, you will get liquidity, you will get all the tokens, you will get with every pair, BTC, USDT, Ethereum, with everything. But what you will get here is transparency and security of your assets, because all of you know what happened with WazirX, right? So that can happen with any exchange, but we are creating reserves for that. So that is the reason why we are, or maybe probably going to be the best in the industry. So you guys must be thinking that you pulled out 1 hour from your busy schedule and attending this PPT about cryptocurrencies. So what is it all about? It's because of this program, that is CIFDAQ Connect. In this program, what we are trying to do is, we are trying to get young individuals like you, so that you guys can, what do we say? Basically, a young man can lead another pack of young men. So I need people like you, that if people like you involved into crypto at this early age, imagine what you can do like later ages of your life. Because even now, 100,000, Bitcoin is at 100,000, you are still not late. And I'm not kidding, you are still not late. The targets given by BlackRock, the biggest AUM of the entire world, is claiming Bitcoin's target to be $750,000. So just imagine, it's still 7.5x from where it can go. So that's why we all are here. This initiative is designed to inspire, educate, and empower students with advanced knowledge in blockchain, Web3, and NFT marketplaces. Prepare for engaging hands-on sessions like seminars, which is happening right now, quizzes, Twitter spaces, webinars, and etc. Would you like to engage in a thrilling quiz? I have some questions, and whosoever will win, we'll have 3 winners, and those will get 1,000 rupees of Amazon vouchers. Are you guys interested in that? I just need a shout out. So let's do this. Just raise your hands, okay? And we'll only take 2 hands, because I have 4 options, and post 3 options, the probability is only 50%. So the guy will get the right answer. Should I start with easy questions or tough questions? Nice, I like the enthusiasm. Okay, what does DEPIN stands for? DEPIN, D-E, capitals P-I-N, DEPIN. Anyone? Do not Google it. I can see a guy Googling it. Please do not Google it. You only asked me that start with the tough one, so that's why I started with the tough one. इतनी देर में तो Google भी हो जाता है. Come on, guys. Decentralized physical infrastructure network. Chalo. This one is, I'll start with the easy one. Where do I find the easy one? When was the first Bitcoin block mined? And I'm giving you the options for it. So wait for it. 2008, 2009, 2011, and 2013. Yeah, I can see many hands. I'll start with Paji. Come on. That's great. It's the correct answer. Joyce, please note that down. He got one right answer. Another easy question, guys. Which country adopted Bitcoin as a legal tender in 2021? Yes. Very good. He's also got the correct answer. Now enough of easy questions. Who are the creators of Dogecoin? Come on. Chalo, I'll give you options also. Elon Musk and Jackson Palmer, Billy Marcus and Jackson Palmer, Vitalik Buterin and Gavin Wood,